really tremendous panelists. These are the guys that can write the checks and really huge movers in the credit market. I think they wanted to introduce themselves. So Ken, you want to start us out? Because he's got a good story.
I got a story. So Ken Kencel, I'm President and CEO of Churchill Asset Management. We are a majority-owned affiliate of Nuveen, which is the asset management business for TIAA. So my largest investor and CIO of TIAA was on the prior panel, Nick Leolis, and he happens to be both my largest investor and also an owner. So great to be here. We manage today, as of January 1, we'll manage about $20 billion in middle market private capital. Our primary business has historically been financing, providing senior and unitranche financing for mid-market U.S. companies. And over our history, we've invested about $13 billion in middle market senior loans. We focus exclusively on companies that are owned or controlled by leading private equity investment firms. And my biggest claim to fame is that I play in a rock and roll band that was just named by Greenwich magazine as the best rock and roll cover band in Fairfield County. So I'm very excited about that. And we are available to play.
Sounds like a banking league table, Ken.
I'm very proud of that.
Best
My wife
band
told me I couldn't say that, but I'm going to say it.
Good thing this is a recording.
Yeah.
Good afternoon. I'm Gregory Robbins. I'm a managing director at Golub Capital. For those of you who are not familiar with Golub, we are a firm that specializes in lending to U.S. middle market companies that, much like Ken's business, is owned and controlled by private equity firms. Firm's been around for 25 years, and today we manage a bit over $30 billion in capital.
Hi, I'm Craig Packer. I'm one of the co-founders of Owl Rock Capital Partners. We're a relatively new direct lending business. Prior to founding Owl Rock, I ran the leveraged finance business at Goldman Sachs. My partner, Doug Ostrover, was one of the founders of the GSO credit business, which is part of Blackstone. We are a direct lending business. We manage 4 funds. 3 of them are business development companies, or BDCs, as well as a senior lending fund. The 4 funds together, when they're fully ramped and fully invested, will be about $20 billion of assets. Like other folks up here, we primarily do transactions backed by private equity firms, first lien, second lien, and unitranche lending to private equity firms. So I'll leave it there.
I'm Mark Liggitt. I'm a managing director at Ares Management. For those of you who don't know, Ares is a $145 billion alternative asset manager. We focus primarily on credit, where $100 billion of that is on the credit side, and then within that, we focus a large majority of that on the private capital side. So $70 billion of our credit business is in direct lending, and that's where I spend most of my time. Like Craig, we focus a lot of our business on sponsor relationships and sponsor investments, and that's
Great, thank you. I guess I should give my plug too, which is I'm a partner at Ropes & Gray, and we have a very large asset management practice, about 40 partners, 180 associates that do funds of various kinds, including a major focus on credit funds. So Ken, maybe you can start us out. Tell us what the credit fund space looks like right now. What is the competitive landscape?
Well, it's interesting. I would say today, the credit markets, obviously there's been a lot of capital raised, upwards of 50 to 75 billion per year, continues to be raised in private credit. But I would say today, it's increasingly a story of what I would say are really haves and have-nots. Scale, in the ability to deliver scale to private equity firms who are buying companies, or even private businesses for those folks who focus on kind of non-sponsored companies. It is really a differentiating factor. And it's interesting in many respects, having watched this business now over the last 25 years and have seen it evolve. I would say that in many respects, and the 4 of us here have really replaced the banks as lenders to kind of mid-market, corporate borrowers, across the spectrum. So, in the ability to deliver a commitment to a company of $200, $250, $300 million, which all of us can do, has really become a differentiator. And I would say that while there's been a lot of capital raised, a lot of it is actually focused on either smaller funds, newer funds, focus more on, kind of higher yielding and some more aggressive strategies. But I would say that in the core middle market lending business that all of us participate in, I would say that scale and relationships have really become major differentiators. So while there's been a lot of capital raised, and certainly we partner with each other, we compete with each other, we often do deals together. It's a little bit like the banks used to be, in the old days. And I would say that in many respects, I'd say we're in kind of the golden age of private credit. When I think about 20 years ago when the lending we did was done by Bank of Boston and Fleet and Chase and Manny Hanny and Chemical Bank, and the reality today is for a good-sized middle market company of 10 to as much as 100 or more million in cash flow, we're the guys in many respects getting those calls. So it's a great time to do what we do. It's maybe not quite as competitive as people think because it's a big space. The private credit market today is upwards of $1 trillion. So it's about the same size as the kind of the liquid leverage loan market. But I would say that the dynamics and the opportunity today in private credit is probably as attractive as it's ever been. And certainly institutions across the world are allocating to our space probably as much now or more than they ever have.
Maybe just to add on to that, I think that there may be some that hear that might conflict with their expectation because there's been a lot of headlines about more competition in the private credit space and more capital raised. And if I could, the way I would reconcile that difference is the opportunity set that private credit can address now is much bigger. As bigger pools of capital form, and we all have pretty sizable pools of capital, we can do private credit solutions for much bigger companies who would have previously tapped the syndicated market. So it's not the same amount of capital chasing, or a bigger amount of capital chasing the same deals. It's a bigger pool of capital chasing a wider set of deal opportunities. We focus on upper middle market companies. Our average EBITDA is $75 million. 5 years ago, they would have had to do a syndicated deal. There wouldn't have been an option then for them to do a $300-400 million directly placed deal, but as more capital has flowed to the space, those options are available. I would suggest those are generally bigger and therefore I would say better companies. So while there's more capital being put out, I think the industry, the direct lending industry as a whole, is actually in a better place because they're doing bigger companies that have more wherewithal. So that's how I would address that. The last point I would make is private equity's exploded. And depending upon what number you'll look at, 1.2 to 2 trillion of dry powder in private equity firms. And if you just take a simple assumption of 50% loan to value in private equity deals, and maybe that might be a conservative assumption, but that would say there's a demand for 1.2 to 2 trillion of financing over the next few years. And the numbers Ken was citing earlier of private credit, 50-60 billion a year, it's really kind of a drop in the bucket in that context. I think that's why we're seeing all the opportunities that we are to transact.
I think the other interesting point to that at the scale point in terms of when you get to some of the credits that we're all looking at in terms of the upper middle market and some of even the bigger transactions, the interesting dynamic from a competitive standpoint, Laurel, is that there's not as many investment professionals in the space and funds in the space that can speak for the scale that we're talking about. And so one of the things that I think we've seen on our side that we've been able to do in the transactions that some of us have worked on together is we've actually been able to drive terms that are more friendly from a lender perspective because there is, while it's competitive, it's a market that we think is one that is one that we can and do invest in, but we are able to drive terms that are more friendly from a lender perspective. And I think when you take that, if you take it from an Ares perspective, the large majority of the transactions that we invest in are with sponsor clients. And I think when you get into that larger realm and the ones that are more sophisticated and understand how the markets work, I think they're very understanding of how to work through that in a transaction in a way that benefits them and benefits us when we can speak for the scale that we can with the speed of execution and the certainty that we provide.
I want to build on a point that Craig mentioned in terms of the opportunity set, because I think it's really important. The theme that Ken mentioned about the shift from banks to non-banks, that's played out. It's something we've talked about for the last 5 or 10 years. It's happened That's old news. It's not fake news, but it's old news. The new opportunity now is the shift from public markets to private markets. It's happened in equities, right? Public equity to private equity, $2 trillion raised. Why isn't the same phenomenon going to happen in private credit? It's already happening. Give you a real-time example. Last week, we announced we're leading a transaction. It's a $1.6 billion one-stop financing for a company called Risk Strategies. It's a Kencel portfolio company. 1.6 billion in the private market. 5 years ago, that transaction would have been impossible.
Impossible.
Now this was clubbed up with 8 lenders, all of whom have dry powder to grow with the business. So I think you're going to see...
All of them are going to hold the loan.
Exactly.
Too.
It's not a syndicated
It's not a
transaction.
distributed, syndicated deal. Yeah.
So that type of transaction is going to garner the attention of other sponsors that are going to wonder, should we be doing that? What are the advantages or disadvantages of having a private transaction versus a syndicated deal? There's a dislocation that's happening right now in the BSL market that's going to drive, I think, some more opportunities towards the private markets as well. So I completely agree with you that this opportunity set is increasing, and I think we're at a very interesting point in our market that is just at the beginning of, I think, what its potential could be.
And maybe just to allude to the point that Greg's making in terms of the specific example of Risk Strategies, is a very sophisticated client who's a very active user of the capital markets, both on the private side and on the public side. But to, in order to raise $1.6 billion, we were able to originate terms that I think are more favorable than what you're seeing in the more public markets. So, for example, that deal has a covenant where if you look at the public markets, it's a very different landscape. And I think that's an example of what I was referring to earlier as it relates to, our ability to speak with the scale that we are and the capital that we bring to bear gives us an advantage as it relates to structuring deals that are more favorable to us and our investors.
So pretty good market.
So how do
Pretty
you
good market.
source the deals? What are the new sort of strategies for sourcing? Or maybe
Well,
not new, maybe old
well,
strategies.
the big distinction, obviously, and you've heard from all of us, and we spend a lot of time in the private equity world. I would say, we hear different numbers, but I would say private equity in the middle market. First of all, I would say the middle market overall, if it were a standalone economy, third largest in the world. So we're talking about a very big market space, right? A big space. And of the middle market in terms of financing, private equity-backed companies probably represent 60%, 70% of that universe. And all four of us focus on that world. So, the big distinction oftentimes is, do you focus on private equity firms and working with them, and you kind of call on them to find your deals? Or are you, I half jokingly say, because I live in Greenwich, are you driving around, Portchester looking for companies? No. So we're focused on businesses that are owned by private equity. And I would say in that sense, as Craig pointed out, lots of dry powder, lots of activity. The current market environment, more dominated by new deal activity. And that's a big distinction. When we go through periods where refinancing is big, particularly where rates are coming down, refinancing starts to emerge more and more, that's when we start to lose some of our borrowers, right? Because they get to a certain size and they say, well, you know what, I can go issue in the broadly syndicated market and I can raise more leverage, no covenants, lower pricing. So I think we're in many respects in kind of the just right phase right now, where there's more new deals going on, that the scale that we all bring to the table helps put us in a position where we can deliver. We've obviously got certainty, we've got confidentiality. We're not going to kind of do a distributed deal to finance. We can actually commit and own the loan. So I would say the current market environment, particularly in the private equity side, is a good place to be right now. And I think that certainly the institutions that we work with, the vast majority of ours are actually in Europe and in Asia, are looking to the US market saying, we think this is a pretty good place to invest. So allocations, particularly in Europe and Asia right now, are increasing. They've kind of slowed a bit in the US, but I would say investor-wise, Asia is still allocating, and we were chatting earlier that a number of our partners, my partner Randy Schwimmer, who's also a Greenwich resident, is in Tokyo right now. A number of your partners are running around in the Middle East and other places. So I think it's indicative of the fact that this market represents very good value from a risk-adjusted standpoint in private credit with top managers.
Yeah, I think the sourcing of collateral is critical. The closer you can be to the assets is where you want to be. You want to be the folks that are doing the due diligence, meeting management, touring the facilities, structuring the deals, negotiating them. We have two primary sources of origination. Our private equity sponsors. We have a core group of about 200 private equity firms that have done multiple deals with us. That's out of around 1,500 in the US, so it's a very large population that we can call upon, but 200 are core to us. And in a given year, about 80 to 90% of our business is with that core group of sponsors. The other source of origination is our portfolio. We're a lead lender to about 250 middle market companies. These are companies that are growing, they're doing well. And as the lead lender, we're in the pole position when they want more capital for an add-on acquisition or a CapEx expansion program or the like to come back to us. So about half of our lending each year is simply by growing with our portfolio companies.
Yeah, I would just add to flesh it out. So you've heard, I think, touched on a little bit, sponsor versus non-sponsor. There are some lenders out there that really try to do non-sponsor transactions. You can get better terms in non-sponsors. Sponsors more sophisticated, but the sponsors are also generate deals, and so it's in a more efficient market. And then you'll also hear gradations based on really on company size. So, and there's no hard and fast rule, but at the 25, 30 million or EBITDA or less, below that, you'll hear lower middle market. You'll hear kind of core middle market at 25 to 50, call it. And then above that, you'll hear upper middle market. The economics are different in those markets. The types of companies you lend to, the types of covenant structures, the types of issues you face as a lender are a little bit different. But as you talk to folks in the private credit space, they'll tend to fall into one of those quadrants based on size and based on backing. I'd say the thing is not always appreciated. We work on transactions that we're looking at for months. When they come in, someone's approaching us on a deal that they're thinking about doing for a company that may be sold. And we work alongside a private equity firm as they're figuring out from their own standpoint if they want to own it, doing the due diligence. We get access to all of that information. We do our own due diligence. And it's during that typically 3-month process where you're doing your underwriting and deciding whether you are comfortable making the loan. And obviously there are checkpoints along the way to make sure it's a good use of time. And then the deal gets announced. It's night and day versus the syndicated markets. The public markets, a deal gets announced on a Monday, that deal's going to get priced charitably, I'll say, within a week to 10 days. What amount of due diligence are you able to do as a public market investor on a deal being prepared by banks who give you a bank book where you don't have access to visit facilities, you're not going to really have access to the management team. If you ask too many questions, it's going to affect your allocation because you're being annoying. It's really a process.
And you have no covenants.
And you have no covenants. So I don't know that folks, I think they perceive that what we're doing is we're waiting for someone else to bake the deal, and then we decide whether we want to do it. We are actually the architects of these transactions, and in some way, shape, or form, we're all managing our own resources to focus on the deals we want to do, and then everything else we ignore. Whereas in the public markets, more or less, you're playing to match an index, and you're going to play a little bit of every deal. And so the resources that we all spend on the origination and structuring and diligence and credit selection are incredible. And I'd like to think you get as close to perfect information to make a decision. Doesn't mean the companies can't have issues, but when you go in, you feel like you really understand the risks and the rewards, and you can make an educated decision.
Yeah, I mean, I would add on to that. I think you're right, Craig. I think there is a misperception, out there about how some of the origination, at least on the private side of the world, does come about. I think at Ares we and have for a very long time have a lot of experience and a lot of relationships, and I think that's what we bring to bear on the deals that we do. Much like Greg was talking about, we have a very sponsor-oriented business. We have over 500 sponsor and non-sponsor clients that we spend time with. We have a very robust origination platform of 100 plus investment professionals who focus their time with those sponsor relationships. So we think over the long term, those relationships and the experience that we have, has benefited us in terms of being able to see, along with our scale, the vast majority of the flow in the market, and then the ability to be selective on that basis.
I think sometimes what's lost as well is that, we compete from a fundraising perspective, right? And we each have our, nuances in terms of how we do the business. And in our track record and performance and all that, which is great in the case of all of us, and we've all been doing it a long time. But I'd also say that we often work together, right? And so it's a very interesting dynamic, right? On one hand, you're competing from a fundraising standpoint. You're also competing in many respects to win the transaction. But oftentimes a sponsor, we all have our core of relationships. Oftentimes a sponsor will say, well, you gave an example of a $1.6 billion transaction.
Three of
We're
us are
working
in it.
together. We're in it, right? Yeah, we're strategies. We're in it.
Exactly.
We're an existing lender and moving in. So I would say that in many respects, it's kind of an ecosystem where we're competitors, but we're also partners.
I believe the term is frenemies.
Frenemies, yeah, frenemies, exactly. And
guys apart.
and by the way, we've also three of us have actually worked together ultimately too, which is another point. But I would say that that's actually very important because in a broadly syndicated loan, the bank underwrites the deal, they distribute the deal, and as Craig said, they call a meeting at the Waldorf, they invite 500 investors, and then that's it. They sell the whole deal, they're out. They don't even own the deal.
You get rubber
Best
chicken.
as they can.
You get rubber chicken, exactly. A rubber chicken at the Waldorf. But in our case, we do the deal, we compete, but at the end of the day, in many cases, we find ourselves working together.
And we're going to hold the loan.
And we're going to hold the
until
loan.
it's repaid.
So, and if there's a problem, we all trust that we are going to operate in a very commercial way, and the sponsor's trusting us to say, hey, you know what? We've got Churchill, Aries, or Golub, or Alwak in the deal. In the deal, and so we're going to be, attuned to that relationship going forward, not just with the private equity firm and the borrower, but also with each other. So there's a responsibility that comes with that, and I would say a healthy respect.
So we heard from an institutional investor panel earlier.
Late end of the credit, late cycle, credit cycle. How do you feel? Nobody asks that question about the equity markets, right? It's always credit, lenders. Are we in where are we in the cycle? I would much rather be top of the capital structure, as you say, maybe 40% loan to value, 4 to 5 times levered in a company that's being purchased for 10 or 11 or 12 times with an owner that has access to additional capital and management resources and a history and a track record of performing and fixing problems where they exist. To me, that's a much better dynamic than playing, in a potentially a more volatile, equity environment. So I think as we think about late cycle, I think more conservative, senior secured, floating rate, good loan to value, not a bad place to be. Even with all the noise about, are we in the 10th inning or 11th inning or whatever, I still think, certainly for quality managers, we're seeing some pretty nice companies trade hands. These are not cyclical kind of, bottom of the barrel businesses. These are businesses that are, that are being purchased for 10 to 12 times cash flow. Now, I think as you go across the spectrum and you kind of go down the food chain, there are private credit managers that will focus on higher risk situations. I would say that as a general matter, certainly I would say for ourselves, and I would say the others, we're generally targeting pretty high quality businesses. We're not going for kind of the marginal credits, but there are smaller firms that have less access to capital, that don't really have the relationships, that are targeting 9, 10, 11, 12%. And at some point, you are getting into a higher risk profile, and that's generally not where we play.
The other topic that comes up a lot is covenants. And I think this is where there's just a lack of understanding. And I understand it because our loans are private and you can't see our documentation. And there's there's a narrative that can develop that the weak documents that are being used in the public syndicated markets are comparable to what's being done in the private markets. And I think it's really just false and there's just lack of information. We are typically all getting maintenance covenants, and our incurrence covenant package beyond the maintenance covenants, it's really strict. It's really tight. You read these headlines about some of the excesses in the public markets, which is a covenant-light market, but it also has very porous credit documents where assets can come out, you can get layered, there's no lien protections, lots of debt incurrence. None of us could possibly run our business where we could afford to lend to a company would have that type of flexibility because we're holding the loan to maturity. And we're oftentimes one of only a couple of lenders. So, I get asked frequently, do you lay awake at night about these types of scenarios? And I don't, because I know how thorough we are in our documentation. And I think the industry as a whole is quite thorough. What I like to say is I think the worst private credit document is better than the best public document that's being done in the public markets by a lot. It's not even close. And so I think that's a concern because documentation in the public markets has gotten so weak. And so institutional investors reading that, and sometimes the press doesn't make that distinction. They just lump it all together and assume it's about the same. I just don't think that's true. I think
Not the Financial Times.
Yeah. But if you think about it,
I'm not going to give them that
but
free
Craig,
pass.
if you think about it, what the liquid investors are technically relying on is liquidity,
Yeah.
right? I mean, the publicly traded markets will say, oh, we'll be faster, quicker, smarter. We'll trade out of that credit before it goes down. Well, the reality is, as we saw in the GFC, at the exact time you want the liquidity, it's not there, right? And the LCDX
100%. traded
to 65, right? Nobody could get out, right? So there's this premium placed on liquidity, and we hear all about liquidity premium, and we certainly capture, 100, 200 basis points in our lending, over the liquid markets. And the reality is that liquidity is a bit of a misnomer, right? At the end of the day, when you actually want it's not there.
It's a lot of bit of a misnomer.
Yeah.
Right?
Yeah.
In the leverage finance space, when markets are trading off,
No bid.
there is the bid ask is dramatic.
Yeah.
And so what does that mean? If you're a public debt investor, you need to invest in the biggest deals with the most liquidity, so that if there's a problem, you can trade out, and you pay a big premium to do that. And direct lending is predicated on, if we're willing to accept that lack of liquidity, we're going to charge a big premium for that lack of liquidity. And we think for institutional investors, that's actually a very attractive trade, as long as you're working with a manager that's going to do good underwriting, have good performance, and be conservative in their credit selection.
So is the answer really, this late in the cycle, you just do more of the same?
More for us. That's really the message.
Stick to the,
Quality.
But I think
quality.
I think also going back to the point we were talking about earlier, one of the things that we very much is important to us is about 2/3 of the origination that we do is with our portfolio companies. Back to the point that was made earlier, and we take that as a competitive advantage no matter where you are in the cycle, because we're dealing with our best borrowers. We're picking and choosing the best management teams. We have intimate knowledge of those credits and what they've done. And we've been able to analyze those credits over a long period of time. And so we have the ability to, be very selective in markets that are like this, where on our side, we're investing in 4% of the deals that we see. And a large portion of that, 2/3 of it, is coming from our existing borrowers, where we feel like we have a leg up on everybody else. And I think no matter where you are in the cycle, that's we think a very good place to be as it comes to picking and choosing the investments that you invest in.
Yeah, I mean, we of our portfolio, same thing. I mean, we did 100 deals last year. We did about $4 billion in origination, and half of it came from the portfolio. Where the company, you're getting the reporting, the CFO, you're in dialogue with the sponsor.
On the board sometimes.
Sometimes as well. So it's that familiarity that is very important to drive in that quality that we're talking about.
But the answer to your question of where do you, relative to what? See, people say, well, I don't know, private credit's late in the cycle, but like relative to what? If you think that private credit is going to go through a cycle, well, what's that cycle going to do to equity prices? What's that cycle going to do to every other asset class? We think it's defensive, right? Because we're the top place in the capital structure, floating rate, all the things that Ken said. In isolation, every asset class has risks to it, but relatively, I think it's still very attractive.
And I think there's another important point, and this ties back to the gentleman who spoke during lunch, the skin in the game, alignment of interest.
Yeah.
We're all investors in our product, in our firm. We own the loan. If it doesn't do well, that impacts us personally. The worst thing you can do in the credit business is compensate an originator based on short-term volume. Anyone can originate a loan. The question is that loan going to repay you at par in 3 to 5 years? So having the right compensation model, having the right incentives, we think is critical.
No, we manage capital, obviously, for third parties, but we also have, and as I mentioned earlier, Nick Leolis, who's our CIO of TIA, is about 1/3 of our capital. So every loan we make, 30% of the loan is actually for TIA. So we are, probably as aligned as anyone in seeing that. And the other thing I would say, and nobody's mentioned this, but I think it's actually a very important point, we're also a very large LP through TIA and many of the firms we work with. And I think that the track record of the private equity fund is also a very important dynamic, right? So when we do business with a private equity firm, we've got the ability to say, okay, well, what's their track record, not just on the private equity side, but have they lost money for their lenders? right? So there are some private equity firms that have a very good return profile, but it's kind of like a casino, 6 good deals, more like venture capital. 6 good deals and then lost money for their lenders on 3. Well, we like private equity firms that have a very consistent profile, and I would say all of us look at that. We look at, okay, this is a firm that's been in business 20 years, they've raised consistent, private equity funds, and they have an approach that, within the constraints of kind of commercial reasonableness, they're going to do everything they possibly can to fix the problem, including potentially, changing management or bringing in additional equity dollars into a business. So the private equity ownership aspect, I think, is really big for us and certainly an important thing that we look at.
So I guess one last question. We've heard a lot about interest rates today. We heard people who think they're going up, people who think they're going down, people who think they're staying flat. Where do you think interest rates are going, and how does that affect the way you're managing your business these days?
Yeah, I mean, I'll take that. I don't have the crystal ball either, so I'm not in a position to say with certainty exactly where it's going. I think we all see the same screens and same forward curve that everybody else in the room does, and I think from our perspective, we're in a low rate environment. We've been in a low rate environment for a very long time. Despite the fact that for a couple of years in the more recent past here, we've seen rates that were going up on a relative basis, still very low rate environment. I think generally speaking, we've been in a kind of long-term secular decline from a rate perspective, and I think it's hard to believe that that's going to change anytime soon. I mean, you've got people out there talking about 0 rate and negative rate. So, I think on our side, Ares and as well as my counterparts here up on the stage, a lot of the investing that we do is on a floating rate basis. So obviously the rate environment is very important to what we do from an investing perspective. One of the ways I think in this market that we're in, that we try to, and we have been for a long time with rates as low as they are and potentially going lower, to manage around that is to manage around a return profile. And one of the ways we do that is by having LIBOR floors in the deals that we do. It's kind of interesting because I think it's something that's been around in the market for quite a while. But I think if you compare it to what's happening in the broadly syndicated market, it went away. It went away real fast, and it really hasn't come back. And 80% of the deals within our portfolio at Ares have LIBOR floors of 1% or more. And I would say that any of the deals that are in our pipeline today that we're looking to invest in will absolutely, all of them will have LIBOR floors. It's very different than what we're seeing on the syndicated side. And so I only contrast it because it goes back to the point that kind of I was making at the beginning, which is I think given where we come from a private perspective and the competitive advantages that we bring to the table for the sponsor relationships that we have, we do have the ability to both drive terms and maintain terms in a way that we think is advantageous to us as lenders. So, that's kind of how we're managing around it, at least, in the book right now.
So what's the LIBOR replacement? Has anybody agreed on that yet?
Seems like it's so
I
far.
think there's a recommendation.
But I think on the declining rates, and I agree with everything that Mark said, there's another implication, which is what is the impact on institutional investors? If rates are starting to go down, which they have been, how are institutional investors going to earn a decent return for their shareholders, their pension obligations? The 60-40 model doesn't work, and I think that's going to shift more and more capital to alternative asset classes like private credit, where you can get premium returns.
I mean, just to say it, the way, in addition to the LIBOR, the underlying LIBOR rate, we lend on a spread basis, and we all adjust the spreads that we're charging borrowers based on where the underlying rate is. So there's some counterbalancing effect there, and you've seen that in the last few years. 2-3 years ago, LIBOR was at 0. Spreads were wider. Rates went up. Spreads came in. If rates go back down again, I think you'll see spreads go wider, so we can all generate the returns for our shareholders that we'd like to generate.
I think it shows some discipline that maybe historically didn't exist in the same way. I mean, we all are accountable to our investors at the end of the day. If you look at yields in kind of the traditional senior secured lending marketplace that we live in, they've been hovering around 7-8%, pretty consistently over the last decade. And I think that's a direct result, as Craig said, of managers that know that their investors have certain return parameters, and they're going to have to live within those and meet those. So I think there is an element of discipline that exists when you're a buy and hold lender, as we all are, as opposed to a market environment where, the large cap market where, they're originating to distribute. I mean, those folks are really in the moving business, right? They're in many cases not holding any of the loans they originate. So, the fact that we hold all or virtually all of what we do, I think enforces a sense of discipline, both in terms of covenants, but also in terms of pricing and rates and structure. So, that I think at the end of the day is a big change, certainly from the business, 10, 15, 20 years ago, where it was the large banks were underwriting, selling off exposure, and not really having skin in the game.
So we did want to leave a little bit of time for questions. Do we have any questions out there? Oh, sir.
Yes. So, Greg, you talked about the fact that there was a differentiation between the large core and lower middle market components. Do you expect any differentiation in the performance of those markets should we go through a downturn?
Sure. Look, our strategy is middle to upper middle market. I mentioned earlier, the 75 million of EBITDA. So I think our view is that that bigger companies have a lot more wherewithal to withstand an economic cycle or other things that might affect their business, because they've got importance in their individual marketplaces. So even if they stumble, there's a potential acquirer or a reason for that company to exist, and they've got the kind of resources and flexibility to take costs out and attract new capital. And we think the smaller the business, the more challenging that is. Now, there will be some that will take the other side of that. I appreciate, but we really like the upper middle market. And it's a core part of our strategy. The other thing which is odd, but I think it's probably intuitive, is although I would suggest the smaller companies are riskier, there's a wider competitive set for the smaller deals, because the amount of capital you need is smaller. And so, there's a lot of folks that can write a check for $25 or $50 million. So the smaller company actually has more options, even though I would suggest they're riskier deals. And we've all talked about, as you get to the bigger companies, it's actually less competitive because there are fewer financing providers that can provide it. But size is not the only variable. Obviously, the credit selection, the sectors they're in, how cyclical they're going to be, those are all going to take effect as well. But we feel good about where we are.
Yeah, I've actually seen some credit documents in the smaller end of the world that are a lot worse than we've been able to construct on the larger cap side of the world.
The one, and I agree, the one advantage in targeting slightly smaller companies is that you can grow with these businesses over time. So we focus on 10 to 100. Below 10, I completely agree. Those companies are way too fragile. They're reliant on, one customer or one key employee or one system. Bad things can happen too easily. But imagine you get a foothold into a company, a really high quality company that has 15 million of EBITDA that's being acquired by a sponsor. 3 years later, it gets sold to the next sponsor, and now it has 25. We keep it in our portfolio.
I think of a deal we did together.
And it goes to 50.
I can think of a deal we did together that actually has done exactly that. I mean, it's over $100 million in cash flow now. We're still in it.
The Risk Strategies deal that I mentioned, the $1.6 billion, started out with us as a $500 million financing a few years ago. So there is a minimum threshold, I completely agree, but there's some value in getting that incumbency and growing with these businesses over time.
Yeah, what you generally see is certainly below 10 million of EBITDA is kind of a red line for a lot of us. I mean, even in a kind of a build-up strategy, I think all of us, in our careers have seen that, a company with $2 or $3 million in EBITDA, in a downturn gets crushed. I mean, just the reality, right? So I would say there is an optimal size. We probably all would define it slightly differently, but it's in that, I would say, 25 to 75 million cash flow, right? Which in our numbers parlance would be kind of credit facility of 100 to 250 million, right? So large enough to have scale, large enough to be backed by a private equity firm with a track record and resources, but not so large as to have graduated into potentially the liquid market, and not so small as to really be defined by a fundamentally very different credit risk.
We're all saying bigger's better.
Yeah. But certainly there's a just right,
Do we have any other questions?
This one in the back.
Oh, yes, thanks.
Just a quick question. Can you speak a little bit about the geographic hedging that you all do as far as not putting all your eggs in one basket or one particular region?
Sure. I mean, as I mentioned, we focus on the U.S., but I think the point you're trying to make is diversification is really important. And I've learned it, I think we've all learned it, that no matter how much you love a deal, you never want to have too big a portion of your portfolio in any one transaction, because the unexpected happens. I could talk your ear off about scenarios where we thought X, Y, and Z was going to happen, and the exact opposite occurred. And the good news is, being at the top part of the capital structure, even when the unexpected happens, you're still generally getting a meaningful recovery. But diversification is critical. Large position for us in our portfolio would be 50, 100 basis points max. We like having diversification. It helps us, like Craig, sleep well at night.
But I think you'll find, look, for the most part, we're financing businesses, I think, primarily U.S., but diversified across the U.S. These businesses, they're national businesses, and I think most of us, we're diversifying by position size, by sector. If you're investing in a business that is so exposed to a local region, that's probably going to be a pretty small business to begin with, and we certainly wouldn't want to have several of those. But I think in and of itself, just being concentrated in one geography is probably a pretty significant risk factor.
But even there, when you think about the types of companies we financed, even though they may be in ostensibly the same quote industry group, right? Take an example of healthcare, right? So we financed Compassion First, which was a chain of animal hospitals. We also financed ONS here in Greenwich, right? Which is obviously a completely different business. We think it's a completely different business. So even within a certain SIC code or within a category, our companies tend to be as different among themselves, because of the nature of our business. So.
Thank you. Thank you all. Thank you so much.
Thank you.
The 2019 Greenwich Economic Forum is brought to you by Bridgewater Associates. Meaningful work, meaningful relationships. Churchill Asset Management, Nuveen, a leading provider of senior and unitranche debt to middle market companies. Ropes & Gray, bright past, brilliant future. Aurora Capital, inspiring partnerships. And Gramercy Funds Management, we are emerging markets. Special considerations to Bank of America, life's better when we're connected. Noah Private Wealth Management, a leading wealth and asset management service provider in China. Guotai Jinan Futures, a leading brokerage firm for commodity futures and financial futures in China. China Industrial Securities, a comprehensive financial group providing full-spectrum financial services in Hong Kong. And Titan Advisors, built like a hedge fund. Special thanks to the Financial Times and Greenwich Business Institute for hosting us. And thank you to all the sponsors who helped make this event possible. We'll be right back after these messages. Don't go away.